Good afternoon, everybody. Welcome to the free little webinar here on calendars and double diagonals. So what I'm going to talk about today's the launch of a new 4-week class we're doing, and we're introducing it with this calendar class. This is for educational purposes only, and you know all that stuff with the disclaimers. All right, let's dig in. We'll go through the PowerPoint, it won't be too long, and then we'll go into the market. I've done a live trade here. We'll talk about it. We'll go look maybe another live trade, talk about execution, and we'll go from there. Overview. Calendar class starting September 7th, which is 2 weeks from yesterday, and ending September 30th. It'll meet Wednesdays and Fridays at 1 p.m. Central for 4 weeks. Class will be what it always has been for the last 4 or 5 years for a 4-week class, $397. Each class will be 1.5 hours. Many times I've gone 2 hours, but so I would say the average class, the average D8 class is about 1.5 hours. So you're talking total class hours, 10 to 12 hours, 10 to 12 hours, meeting Wednesdays and Fridays at 1 Central. All classes are recorded and archived. Even if somebody bought the class 5 months after we did the class, the beautiful part about it is recorded, archived, and on the student page where you can go and watch them, there's a tab that says Ask Questions. So 4 months after the class, you can ask questions about the material, and they come right to me. So that's a beautiful thing, isn't it? Live trades, all classes Dan teach. Again, the key to our online class is I'm not in the business of trying to teach you just a concept. I'm in the business of trying to teach you as practical as I can. So most of our classes will involve teaching, live trades, exact risk management adjustments. We talk a lot about execution. So we're trying to give you the whole thing so you get an idea of how to get the, as best as we can with a 4-week class, how to do it. Everything will be recorded. So if you work and you can't see it at 1 p.m. Central, usually an hour after the class are available for recording. Now the nice part is during the class, I'm answering questions all the time. So you're probably a 70% chance your question will be answered during class, but if it isn't, you just ask it. All right, so that's the information. I think it'll be a very practical class. I think it's one of our key strategies for weekly and monthly income, and I think if you're interested in becoming a craftsman, really stepping over the line and trying to learn how do I do this, the practical, how do I leave the world of a book and get into practically how do I put these things on, how do I manage the risk, how do I pick the vehicles, what do I do, how do I guard against the volatility risk, on and on and on and on. I think this would be a very practical, helpful class to you. All right, so let's go through. These are going to be some of the topics that will be covered during the class. Generally, how this will work, if we have 8 classes, I'll probably teach at least 6. Mark Fenton, who mentors with me, will teach 1. He's excellent at double diagonals. My guess is he will cover something on double diagonals. He's very good at it. And then Jay Bailey, who's a mentor with me, excellent. He's develops, like Mark, developed different strategies. And specifically, we do like a 9-day Russell calendar and other stuff. And I think Jay will address that. And some of the tweaks we've made, that he's made and to this particular strategy. So I think that'll be, so that's kind of how I'm looking at this class. Jay will do 1, Mark will do 1. So some of the topics will be what are the best vehicles for calendars and double diagonals. We'll go hot and heavy into the Greeks of the calendar and double diagonal so you understand them, because a lot of the, I'd say 80% of the time when someone tells me they haven't been consistent or they're losing money, they've tried some calendars or double diagonals or whatever, butterfly, a lot of it's because they don't understand the Greeks of the trade, right? Really, I think that's probably one of the biggest things. We'll be talking about adjustments, when you would adjust, and then how we would adjust. Some people think the adjustments are the most important thing. They're not. The most important thing is that you have a risk management plan, how much you're willing to lose or make on a trade. The second most important thing in a plan is when you would adjust. The third most important thing is the adjustment, right? You can have a Michael Jordan adjustment, but if you adjust at the wrong time, who cares, right? Execution of live trades. There'll be a lot of live trades during the class, so we'll really get into execution and how to get the best execution on an 8-day calendar or double diagonal or a 30-day. So again, practical. Risk management of calendars and double diagonals. You know, how do I set a profit target? How do I set a plan? Where should be my max loss? When should I adjust? All those things. And then we'll go through a series of different calendars and we'll compare them and let you see the differences, and we'll give you methodologies that we've been using for years on these different things. A single calendar would just be, you know, you do one calendar, right, where your graph looks like this. 10 calendars, double and triple calendars. A double or triple calendar is going to start looking like an iron condor because, you know, it's going to look more like that type of thing. But we'll discuss those, when I would put a double or triple calendar on, how I would manage it, when I would put a single calendar. I prefer starting with a single calendar, and I'll tell you why. But I'll tell you there may be some situations I might do a 10th calendar. Speculative calendars, 3 types: ratio calendars, reverse calendars. You would do more in a higher volatility environment, and directional calendars. We'll talk about, again, the nice thing is we'll talk about specifics, when we would put them on, what strike, how we would manage them. And we'll spend quite a bit of time on short-term, weeklies or short-term trades, where there's short options of a calendar or double diagonal, where they maybe expire in, you know, 6 to 10 days. So shorter-term trades. Rolling calendars. I call these campaign calendars. It might be where you sell a 30-day option and buy a 200-day option, or buy a leap. And these are interesting trades, these campaign calendars. And in a way, there's a lot of comparisons between how many of you buy a leap, and then maybe if the stock goes up, you'll sell calls against it. With this rolling calendars, we'll talk about that because it's kind of a flexible strategy where we may start off with a calendar, but depending on the price of the movement of the underlying, it may turn into like a diagonal type thing where you're not at the same strike. We'll also address something I call guerrilla calendars, which are basically calendars in lower price stocks. Like, you know, if you ever did a calendar in like an Intel or a Microsoft or something like that, a calendar that's maybe you pay 30 cents, 40 cents, 50 cents, or 60 cents. And I think those are very good calendars. I've done a lot of them, and I think trading a 30-day calendar is a completely different trade to me than trading a short-term 7-day calendar. Trading a guerrilla calendar is totally different than the other calendars. So, you know, are they all the same? No, they're totally different because the Greeks are different. Double diagonals are basically, you know, one way to put it is an alternative to an iron condor. And the next, managing a $10,000 portfolio of calendars and double diagonals. Towards the end of the class, I'll talk about how do we do this? How do we manage a $10,000 portfolio of calendars and double diagonals? How would I do that? So kind of putting it all together. So this is what's going to be covered. First thing we'll talk about is SPX 8-day calendar. But before I get into there, let me go to the chalkboard a second just to make sure we're all on the same page. So if we're looking at, I'm just making this up, if XYZ is at $100, right, and we're looking at maybe August options, right? And an iron condor would be something like this. Sell one, buy one, sell one of the August 110 calls, buy one of the August 120 calls. Sell one of the August 90 puts and buy one of the August 80 puts. So an iron condor is an out-of-the-money call credit spread and an out-of-the-money put credit spread. So we've got a problem. What's the foundation of an iron condor? All right, we're selling one of the 110 calls, and we're selling one of the 90 puts. What do you call that? A short strangle, right? So an out-of-the-money call and put, and then we're buying our protection 10 points more out of the money. So The foundation of an iron condor is a short strangle. Well, if we go to the world of a double diagonal, it's very similar. You might start with the same foundation. We're selling the 110 calls in August. We're selling the 90 put in August. But the difference is, in an iron condor, our longs are in the same expiration as our shorts. A double diagonal is saying, you know what? The VIX is 11, 12, or 13. Instead of buying my longs in the same month, August, let's go buy my longs in November. Why? Pay more time premium, and it would reduce my short vega exposure on an iron condor, your volatility risk. So instead of buying my 120 calls in August, I buy my 120 calls in November. So my shorts are in August, my longs are in November. So for the easiest way to explain it, it's the same thing in a way as an iron condor, but my longs are the next month out. I'm selling the same shorts and the same expiration, but my longs are out a further duration. So when would I do that? I would do that in a lower volatility environment. Kind of the basis of a double diagonal. How many people have heard the fallacy, you can't sell options when the vol is low? How many people have heard that? Right? It's not true. Why? Because when I buy my longs in a double diagonal further out, I'm going to be a little bit long vega. Anyways, so that's my story and I'm sticking to it. Now, when I'm talking about calendars today, let me spend 1 minute on a calendar. Just want to make sure we're all in the same ballpark and that none of you are in Magic Kingdom, all right? So stocks at 100. I sell one SEP 100 call. Buy one OC 100 call. So what is a calendar? Calendar generally for an income calendar is I'm going to sell the SEP 100 calls and I'm going to buy the OC 100 calls. So generally it's the same strike. My longs are going to be a further out expiration than my shorts. All right? And how do we make money in a calendar? How would you explain to your mailman today? Your mailman comes to your house today, gives you the mail. He wants to know in 15 seconds, how do you make money in an at-the-money calendar like this? Time decay, correct. So even though you might sell your SEP 100 call, I'm making this up, might be $3, and your OC 100 call might be $5, so you pay $2. Usually calendars, you pay a debit. The way you make your money is, so let's say this is 30 days from expiration. How do you make your money? That would be $200. That's your maximum risk on a calendar. How do you make your money? Well, you make your money at expiration if the stock is right at in 30 days when the SEPs expire and the OCs still have 30 days to go. What's your SEP going to be trading at? 0. What are your OC 100 calls? Are they going to be at 0 in 30 days at SEP expiration if the stock's at 100? Are your OC 100 calls going to be at 0 in 30 days at SEP expiration? Give me a guess. What do you think they'll be trading at? Let's say $3. All right? So what's the spread trading at? That's why your best place is at the short strike. So if I paid 2 debit, the way you make money on a calendar, you'd sell it for a 3 credit. Does that make sense? Just for those of you maybe who have never traded a calendar, that's at least the basic gist of it. I talk about one thing we stress at Sheridan Mentoring is income trades. Again, your mailman comes to your house today and says, hey, I heard Dan Sheridan talk about income trades. Can you tell me in 15 seconds or less, what is income trades? An income trade is a positive theta trade. How is this a positive theta trade? Even though I'm selling something at $3 and I'm buying something at $5, I get positive decay because even though this number is smaller than this number is going to decay quicker. So I'm going to get positive decay every day. Does everybody understand that? how do you get positive decay when I'm selling something at 3 and I'm buying something at 5? Because the one I'm selling at 3 is going to expire a lot quicker than the one I paid more for. So I'm actually going to make more even on less money because I'm selling something a lot closer in. All right, let's talk about different calendars for a second. Here's an SPX 8-day calendar. I'm selling the SEP2 expiration, which expires in 8 days, and I'm buying the SEP16 expiration, which is 22 days from expiration. For when I'm doing short-term calendars, like where my short expires 8 days from expiration, I like to keep a minimum of, not always, but a minimum of 14 days between my short and my long, because I don't want the time decay of my longs to get in the way of the positive time decay of my shorts. So in this example, SPX was at 2180, and I bought one 2180, sold one 2180. This is pretty typical. I like SPX. It's a very well-diversified vehicle, very good liquidity. This is the expiration graph. It was going for $6.60 debit for one contract. Again, is your duration our short? When I say an 8-day calendar, it's kind of referring to the short. Our short is 8 days from expiration. That's the key. So let me ask you a question. Here's the graph. Here's what we would call the, when you look at the expiration graph, folks, and you look at the where the expiration line crosses 0, where the expiration line crosses 0, what do you call that? So these are called expiration break-evens. They're not eyes, right? This could look like a shark, right, coming out of the water, but those are expiration break-evens. And when you're doing an 8-day trade, especially in a very low volatility environment that we're in now, you know, you might get 15 points either way, you know, 15 points up or 15 points down of the current price. So you have that window, and as long as we're in that window, 15 points up or down, you leave it on and you percolate like a good cup of Folgers coffee. You make your money. If it goes outside of the expiration break-evens, that's where you have to adjust or take it off or do something like that. That's the basic gist of these calendars. You know, generally, if I put a calendar on 8 days from expiration, you would put it on a Thursday. If I put it 9 days from expiration, you put it on a Wednesday. 10 days from expiration every Tuesday. So it's that kind of every week. Here's the Greeks of this type of calendar. So basically at the money, 2178, 2180, you're pretty neutral. You have positive theta. This is just one contract, $660. The Greeks are your theta, time decay, the day we put it on, like say today would be $27 positive. I'm bringing in net $27 from positive theta on my shorts over my longs. My vega or volatility risk is 76. But this ratio of about, what is this, about 2.5 to 1, this is normal theta to vega ratio for weekly calendars. The theta to vega ratio for 30-day or 40-day calendars might be, it could be 7 to 1, 8 to 1. So when I'm doing 8-day calendars, do I fear volatility risk? Usually. No, not much. Why? Because theta is big enough on these short-term trades, and vega is usually lower. Theta, especially as days go by, is big enough to fight the battle against vega. But when you're doing a 30, 40, 50-day calendar, your vega is so much bigger than theta, so your volatility risk becomes a much bigger deal. The whole thing with short-term calendars is the price movement. That's what it's all about. But again, the most important thing is putting the stinking thing on every week. Another little topic, calendar skews in SPX. What does that mean? Everybody agree we're in a low vol environment and the price of the underlying is high. So just if we take a look, here's the SEP2 expiration, 8 days from expiration. The implied volatility of the at-the-money call today, in the morning when I looked at this, was 9.42. The SEP 6 expiration, 12 days, excuse me, I just went a week at a time. So SEP 2 expires in 8 days is 9.42. Go a week out, the SEP 9 expiration with 15 days to go has an implied volatility of 8.96. The next one, SEP 16 expiration, that expires in 21 days is at 9.08. The SEP 23 expiration expires in 29 days is 9.96 implied volatility, and the at-the-money calls, all the same strike. The SEP 30 expiration, 36 days to go, 10.07. OX 7, 43 days out, 10.08. And OX 14, 50 days out, is 10.28. Now, what does all this mean to you as a retail trader? First of all, are we in a very low volatility environment? Yes. So what do we call that where the volatilities rise as you get farther out in time? What's the fancy word for that? Contango. What does that mean? It means the volatilities are higher as you go farther out in time. Why? Here's why. If I'm a market maker in the pit and I sell an 8-day option at a low price, it doesn't bother me as much. Why? Because there's not that much time premium in a 7-day option. But if I sell a 30-day option at low volatilities, because VIX is low, is there more risk? There's a lot more time premium on a 30-day option or a 60-day option. So most of the time, 80% of the time over the last 5 years, we've been in contango. Why? We've been in an up market. In an up market, it's very normal that the volatilities are going to increase as you get further out in time, because market makers are not going to sell, you know, with the VIX at 11 or 12, guys in the SPX are not going to sell options that low volatility 6 months out. Why? Because there's too much time premium, and if the volatility goes up, they're going to get hammered. Are you going to get hammered selling a 7-day option and the volatility goes against you? No. Why? Because Vega, or your volatility component, your time premium component, is much less than an 8-day option. So anyways, the other thing I want to mention is, if we did a calendar, what is a skew, right? So if I'm doing a short-term trade, I sell an option with 8 days to go at a 9.42 volatility, and I buy a 15-day option against it. So I buy a 15-day option, buy one of the SEP 9 expiration, the at-the-money call, which is 15 days from expiration, and I sell one of the SEP 2, which is 8 days from expiration. Well, I'm buying an 8.96, I'm selling a 9.42 volatility. What kind of skew do you call that? What kind of skew? It's a positive skew where your short option volatility is higher than your long, right? And you'll find that more in options that are close to expiration. As you go further out, you won't find it much, right? Because if you look here, if I'm going to sell a 30-day option, or let's say I'm going to sell this 29-day option as 9.96. I sell one 30-day option, and I buy one October option that's 43 days out at a 10.08. You're going to get a negative skew. So generally, when you get positive skew, it's going to be more with weekly options, and frankly, it doesn't mean anything. I know some people get anal and they say, well, I got a positive skew. Again, most of the problems with retail traders can be solved as far as their understanding of options if they thoroughly understood the Greeks. For somebody to say, hey, Dan, I got a positive skew. I bought a 15-day option at, you know, a 9 volatility, and I sold a 8-day option at a 9.42. If they're getting really excited about that, they do not understand the Greeks. A positive skew like this that I'm looking at today, in today's market environment, a little bit of a positive skew where I'm buying a 15-day option, selling an 8, doesn't mean diddly squat. Why? Because there's no time premium in these things. It doesn't mean a whole lot, right? Volatility is, not a big deal 7 days from expiration, right? So it's normal in a low vol environment if I'm doing buying a 60-day calendar, selling a 30-day, if I'm buying a 60-day option, selling a 30-day, it's going to be normal to have a negative skew. You're always going to have a negative skew. How do I get a positive skew on my calendar on options over 25 days from expiration? I'm not talking about an 8-day. There's only one way. You need a sharp drop in the market, which will jack up the vols. I mean a good, 1.5%, 2% move market. That's it. Double diagonal. How's this for a dramatic opening? I am going to introduce to you folks the most flexible option strategy ever invented. This is the most flexible option strategy ever. How? I'm going to show you a double diagonal, the same double diagonal, the same shorts, long volatility and short volatility. Such a deal. All right, I'm selling the SEP. My shorts are in the SEP 16 expiration. How many days are till the SEP 16 expiration? How many days till the SEP 16 expiration? 22? All right. So I'm 22 days from expiration. Amazon is at 758-ish. I'm selling the out-of-the-money calls, same foundation of an iron strangle, the out-of-the-money calls. Stock's at 758. I'm selling the 775 calls, so 745 puts. SEP 16 expiration, about 22 days out. And then I'm buying my longs, remember, iron condor alternatives, in the SEP 30 expiration, 2 weeks further than my shorts. I'm buying the 800 calls and the 720 puts. So my out-of-the-money calls and my out-of-the-money puts are how far out of the money? What's the distance between my short call and long call? Short put and long put? 25. Can you see why I'm calling this an alternative to an iron condor, that the graphs look similar? Yeah. If you look at the Greeks, on 10 contracts for this trade, my Greeks, or delta, that's a sign for delta, short 5 on 10 contracts. Now, this is just illustrative purposes. The margin on this would be about 22K. So just so you can see. There's about a 22K position, 10 contracts. The delta is short 5. The gamma, sometimes I use bigger contracts here just because you can see the Greeks clear. The Greeks, I'm short 10 on the gamma. My theta is 172. Wait a second. My vega is short 100. Dan, I thought double diagonals were long volatility. Are you telling me you can do a double diagonal at short vega, long vega, neutral vega? You bet your britches, my friend. So wait a second. This is a double diagonal I'm doing for short vega. Isn't that something? So how do you think I can take this from a short vega trade, double diagonal, how do you think I could take it to a long vega trade? Anybody got an answer? Narrow the wings. You got it, my friend. So instead of 25-point wings, same shorts, same expiration, but instead of 25 wide, my longs are 795 and a further out expiration, and 720. Aha. So the width is now 20 from my longs to my shorts. And you can see the new Greeks, the deltas are about the same. Well, I'm a little shorter, short 23. Gamma, short 9. Theta, 142, positive theta. But vega, 21. So just by going from 25 wide to 20 wide, now I'm positive vega. So this would be kind of an iron condor graph, but closer to neutral vega. Yeah, you got to watch the sag there in the middle. Absolutely. How much delta do you pick for the short putting call? It depends. I like my short options. You know, it could be anywhere from a 20 to 35 delta for my short options. All right. And then last thing I'll talk about here, this is just a live trade that I was looking at earlier at 11 a.m. today. I'm just doing this just to illustrate live trade, talk about it. So live trade execution, Russell was 12:40.33 at 11 a.m. today Central Time, August 25th, which is today. Excuse me, here's the trade. I'm buying the SEP 16 expiration, selling the SEP 2 expiration at the money, 12:40 call, 12:40 strike, and the mid was 5:40 at the time. So if I'm selling the SEP 2 expiration, how far out is my SEP 2? 8 days, right? So this is a short-term calendar. Put it on a Thursday. The options expire a week from Friday. When I brought it up, it said mid 540. If I wanted to buy the ask on my long call and sell the bid on my short call, the natural, I could have done it for 570. The mid was 540. 2 minutes later, with the price about the same, now the mid is 545. Dan, are you telling me that the mid price has changed? They do. So I like to watch it for 5 minutes before I do it. It's at 545. So you can see the mid has gone up. The price is about the same. Again, this is a short-term calendar. I treat execution differently on an 8-day calendar as I would a 30 or 40-day. I'm much more aggressive trying to put on an 8-day calendar because your theta is bigger. Now, I got filled for 545 debit at 11:05 a.m. with RUD at 12:39. All right, so I didn't mind. I just, you know, you say, well, you paid up. I didn't. I mean, you know, the mids were varied between 540 and 545 debit, so I watch it for at least 5-6 minutes, and I got executed, and that's kind of the whole thing. Generally, you know, if I put a calendar on an 8, you know, where my short is 8 days from expiration, I expect to be in 2 or 3 days. Anyways, I think it's going to be an exciting class starting 2 weeks from yesterday, and you can just go to Sheridan Mentoring to sign up. If you have any questions about the class, you can ask now. You can email me. Excited to do a calendar class. I think it's a great strategy. And again, we've been mostly in a low-vol environment over the last 4 years, I think this is a good strategy. You can trade it in a low-vol, high-vol environment if you understand the Greeks correctly. All right. Well, thank you so much, everybody. Glad you were here. I look forward to seeing you 2 weeks from yesterday for the launch of the calendar and double diagonal class. Thank you.